Hey guys, how's it going? Eli here, back with another video where today we're going to have a conversation in what my personal opinion is on where I think we're going to find the absolute bottom in the Pokemon market. Without further ado, let's just jump right into it. So as always, doing weekly giveaways, all you have to do to enter is be subscribed to the channel, leave a like and comment down below on any of the 3 videos we post each and every week, Monday, Wednesday, Friday. We do our giveaways every single Monday is when the winners are announced. And as always, as we continue to increase our subscriber count, we will give away more and more product. We're currently sitting at around 909 subscribers as I record this video, and we are almost at 1,000. So I can't thank everyone enough for the support. Once we hit that, we're gonna hit it before I'm gonna be honest with you guys. My goal was to hit it before the new set release, which is February 25th, if I'm correct, 27th. Around that time. We're about to shoot it almost a full month early, so thank you guys so much for the support. So I'm gonna have to give away 8 Fusion Strike packs because that's about all I have as far as it goes for packs. People have been asking me, well, can you give other packs away? I'm completely out of evolving, I'm completely out of battle styles, completely out of chilling, so Fusion is the only product I really have left. But when it comes to the new set release, it'll be all Brilliant Star, and that'll be the transition. However, now, jumping into today's topic, and one that I think is going to be a very popular one, I'm going to title it, my prediction for the bottom, or whatever it is. It's going to have something to do with the bottom in the title, because this is going to be really the main focus, and we're going to look at correlation as well. So the first thing we're going to do is we're actually going to look at this article. So for those that didn't see, I had a very in-depth video in regards to how I said that there was a correlation in between the retail markets as well as the stock market. And so without getting super in depth in this video, because I know it can be overwhelming for some people, I'm just going to give you a broad corollary trend and why this is important for you guys to kind of do your own research in this. So this is an article from 2007, June 15th, by CNN Money. Bonds, the worst may be over. After a sell-off, it sent the 10-year treasury yield to a 5-year high. Some experts think rates have peaked for now, or have they? So basically, this is just a general article that came out literally in 2007, June 15th, which for those people that don't know, market crash of 08 happened shortly after. But one of the things that was very interesting to kind of take a look at is you saw a 10-year treasury yield high, as you can see with the chart right here, with the yield curve. It absolutely started to skyrocket right before the market absolutely plummeted. You obviously saw some issues having to do with the subprime mortgage and the rating agencies, but that's really in depth, and I'm not going to really get into that part. But this is still something that I really wanted to point out because I think that's super duper important for you guys to look at. Now, this is an article that recently came out today. U.S. government's bond yields rise after the Fed announcement. So for those people that don't know, there was an actual Fed meeting that happened this morning. Why this is relevant is because obviously, as we talked about in our last video, there's about 7 to 8 Fed meetings, if I'm correct, that happen each and every year, and they really play an impact on the future of the market. So with what happened at the Fed meeting, Chairman Powell came out and announced that they are going to proceed with the interest rate hikes, and potentially they could be very, very aggressive throughout the year. Expectation is still 4 rate hikes even after the market's dumped. So if that doesn't tell you what kind of future we're going to have or how grim it's going to be, then I don't know what does. Once again, as we saw with the last article, obviously you saw bond yield rates hitting their all-time highs. Well, in response to the Fed announcement that they're going to be raising the rates, the bond yields also rose as well. With that being said, what happened in 2007 after the bond yields hit their all-time highs? 08 market crash. U.S. government bond yields rise, and they're rising aggressively. What do you think is more than likely going to happen again? Now, of course, not financial advice, not financial advisor. Take everything I say with a grain of salt. But all I'm telling you guys is there is a huge correlation in regards to what's happening with the bond yields in the current state of the government. And that is something that, in my personal opinion, is very, very scary. We're going to take a look at a chart recently. This is the NASDAQ chart. For those people that don't know, NASDAQ, it's one of the 3 main kind of indicators of the overall health of the current stock market. You can look at the NASDAQ, the SPY, and then you can also look at the Dow. Those are the 3 things you kind of want to take a look at. So for those people that can see at the chart right now, you can see in the month since the start of the year, or the monthly chart, it has gone down almost 15% since on start of the year. For those people that also don't know, it's actually breaking records for the most consistent red days in a row, which we haven't seen in 9 decades. When I say red days in a row, I mean literally red day, red day, red day, red day, red day. Not percentage perspective, but red days. So we're talking about record-breaking downs in regards to the overall market, which of course this is going to have a huge corollary effect into what happens with the Pokemon market, because as the stock market, takes a hit, as you start to see things become more expensive, the GDP growth in the economy starts to go down, you're going to see less and less demand for retail goods because there's going to be less and less money in people's pockets. So with that being said, it's very important that people once again see this as an indicator for potential bottoming of the Pokemon market. And when I say, see it as an indicator, I basically mean that we're not anywhere near close to the bottom, in my personal opinion. Because this is something that if we're going to see a market, absolutely collapse in the next year or two, then who knows what'll happen. Now, of course, there's a lot of kind of factors at play, especially when looking at macroeconomic policy. Obviously we've got the midterms coming up in November. And so that's going to also play a little bit of a factor in regards to market sentiment. Historically speaking, economic recoveries typically tend to work the best during presidencies where there's gridlock. What do I mean by that? So let's say, for example, if Biden were to lose the House and the Senate, then that means, he's going to be able to veto a lot of the bills that happen in the House and the Senate, but also, House and the Senate is going to be able to block any sort of policies that he tries to implement using his presidential power. Same concept with when the Republicans lost the House back in 2018 with Donald Trump as president. It's just one of those things where markets tend to have a lot more comfortable sentiment when there's no power at play, when there's no policies that could potentially crash the market. Obviously, there's been a lot of spending that's been happening in the past couple of years. You had your, of course, initial spending during the Trump administration in regards to the COVID pandemic relief. And then after that, there was an extra relief package that happened with under the Biden administration. Now, of course, whether you want to say it was essential or not, you also have to admit to the fact of the matter that we're currently sitting in a lot of financial debt as well as a rapid rate of inflation. Obviously, I'm not going to say here nor there or get political in this. All I'm going to say is that you've seen a rapid rate of inflation over the past couple of years, and of course it needs to be put in control. That's one of the reasons why, once again, talking about what the Fed announced with the interest rates that are going to be coming in March. So everyone, you're going to be very, very wary of this. Of course, the real question is this going to hit the market now? Is it going to hit the market in March? My personal opinion, typically what you'll see with events like this is it's usually the lead up that kind of gets the market sentiment correct. And then when the day actually comes, it doesn't really have a huge effect. Because once, people hear about the news, that's when they have their visceral reaction because they want to get ahead of it. Where in reality, that's just how everyone is. That's just how the market reacts. So in regards to this, Chairman Jerome Powell added the Fed could move on an aggressive path. I think there's quite a bit of room to raise interest rates without threatening the labor market. Powell said as post-meeting news conference after being up strongly earlier, the major stock market average turned negative shortly following Powell's pronouncement. The committee's statement came in response to inflation running at its hottest level in nearly 40 years. Obviously, that's something I've really touched on, said we haven't seen it since 70s and 80s. So this is something that, once again, it needs to get put in control. It needs to get taken care of because at the end of the day, it's going to hurt the bottom line or the value of the United States dollar, which of course then is going to cause, less spending power in regards to everyday Americans' pockets. Regardless of whether you're making, you went from 10 to 15 in minimum wage, the rate of inflation is going to outpace that. And so the value in theory, in your eyes, you might say to yourself, oh, well, it's actually going to be, I'm making more because I'm making 5 more, an hour. But in reality, that's not true because inflation and the cost of everything around it is causing you to spend thousands more a year, which is going to outpace the actual wage growth. So you have two things. You have the, unnecessary, you have the necessary, you have, how do I want to put this? I think it's necessary that we do see, a correction in the market. Not in the terms of like, oh, we need like to end this bull market, but in the correction of we need to do what's needed. We have to do what's needed in order to fix this inflationary rate. Now, they're saying their prediction is they're going to try and get it down to 2% by the end of the year. I think they have their head in the clouds to be able to do that, unless they're literally going to be super duper aggressive and you're going to see the overall rates go up 10+%. I highly doubt they would do that, because that would absolutely collapse the economy. But I could be completely off base, and who knows how aggressive this administration is really going to try and be in correcting a lot of the issues that the United States have caused during the past couple of years. So with that being said, now it leads into the ultimate question, or the answer that I know a lot of you guys are kind of looking for me. Where do I think the bottom is going to come in? I think there are actually multiple outcomes in my personal opinion, and they could change throughout the year. So this is very important for you guys to understand. And this really comes down to every single update the Fed has when they have their meetings. So that's something very important for those people that are listening to my words. Hear the sentiment that is going on during the Fed meetings, because that is going to play a huge part in what is going to look at macroeconomic policies in regards to a recovery, as well as the effects it's going to have on diminishing or aiding inflation. So, number one, my personal opinion, what I could potentially see happen. I potentially think, based on what we're seeing from recent political news, once again, I myself am not saying anything from one side or another. I'm just saying what there's a lot of experts have been saying on both sides. There is a prediction that basically during midterm times, you typically see right-leaning people, especially when you have a left person in office, aka Biden, right-leaning, aka like conservatives. There typically seems to be a swing shift in regards to voting patterns. That means, with that being said, it's basically a tie at this point right now in the Senate. Of course, with ties, you have Kamala as the tiebreaker. So technically speaking, the left has or liberals, whatever you want to call them, it doesn't matter. Same thing with conservative, right, however you want to call them. They technically have a majority. They definitely have a majority in the House as well. It is predicted that they're going to lose both the House as well as the Senate, especially considering they have currently it's a very low approval rating by both the president and the vice president. The expectation, of course, within and of that is that there is going to be gridlock. And this is once again goes back to what I'm saying. So the expectation is that gridlock is actually going to be a good thing for a potential market recovery, just like it happened when 2018 you saw President Trump lose the House. It was actually a good thing because you had economic policies that were potentially not going to be able to get passed. Whether you agree with his policies or not, I'm not going to get into that. All I'm going to say is that gridlock is good. Gridlock in 2018 was good. Gridlock in 2022 is going to be good if it does happen. Of course, with everyday polling, you got to give yourself a point of error, but considering the fact of the matter that we're talking about a huge potential swing happening based on just historical patterns, I think it's very likely. And I think that with that being said, you can see a huge visceral market reaction occur to that in November, when we see what happens in the midterms based on if that gridlock occurs. So that's one of my number one indicators for where we could potentially see not necessarily a macro bottom, but just a short-term area of recovery. We could, of course, find a macro bottom, but I don't have a crystal ball. I can't tell you if it's going to be the bottom. All I can tell you is just certain indicators that potentially could play a factor in regards to what could potentially happen in the future. Number two, the next thing I think that could potentially happen is, and this is more of a dire one, this could be a lot bloodier of one. We could potentially see if the bond yield rising curve really gets out of control, and we truly see a 2007-2008 mirror, and the market absolutely crashes. I could see there potentially not being a bottom for another, 2 years, I want to say. Market recovered. Technically, it found its bottom in 2009, and then it started really to recover in end of 2010, end of 2011. With that being said, if hypothetically speaking, we say that we are currently in 2007 and next year is going to be 2008, then once again, I think we could find that bottom in 3 years. For those people that, of course, don't know, whether you want to make the argument that the reason why the Diamond and Pearl era was not super popular was because a lot of people didn't like a lot of the, Pokemon product in Diamond and Pearl, or the EX era, or, the black and white era. I think there's still an argument to be made that a lot of macro, economics still plays a factor in regards to that demand, because when once again you have a huge financial, devastation hitting the economy back in '08 during the time of the level X era, there's an argument to be made that the demand for retail goods and services has gone down drastically. And with that being said, it of course plays a factor into the overall prices and so on and so forth. With that being said, if of course we do see a huge economic crash occur sometime, early to late next year, then that's where you could potentially see that happen, where we're going to once again see a massive bear cycle over the next 2 years, until we find that bottom potentially in late 2023, early 2024. Of course, once again, all hypothetical. This is all speculative. I don't have a crystal ball. We're just putting out hypotheticals based on what we've seen from historical data. Everything I want to give you guys is based off of what we've seen from history. Everything I'm going to give you is based purely off of statistics and facts. I'm never going to give you any sort of political opinion on things, because we're here to make money, not talk about politics. Now, lastly, what I think could potentially cause the overall recovery to happen, I don't want to say the soonest necessarily, but basically if they just completely ignore inflation. This is completely possible if the market gets so bad and the overall, let's just say, approval rating of the American people in regards to the fact of the matter that a lot of individuals are getting absolutely killed by inflation currently, starts to, cause a lot of issues in the political leaning world, then you could start to see them shift their narrative once again during one of these Fed meetings. Obviously, it sounds like they've doubled down. My personal opinion, I think that's a good and right play. I think that they should double down. Obviously, it shouldn't have gotten this bad to begin with, but obviously there are a lot of factors at play in regards to, the overall COVID pandemic. When you try and shut down an economy for so long, obviously there's got to be some form of stimulation to get out of it. The question, of course, now is there going to be more policies that are going to be these multi-trillion-dollar packages that are potentially going to put us more into debts, more into higher rates of inflation, which is of course more important. Hopefully that won't happen, because that of course is just going to lead to more inflation. And on top of that as well, once again, taking a look at it, I think as far as it goes right now, I think the Fed is going in the right direction. Obviously, this is just my personal opinion, but I think that you're going to have to see some blood in the streets to be able to finally get over this, because when you have to recover from such a long time of having an economy shut down for so long, you're going to have to pay the piper at some point. Whether they decide to push off a lot of the interest rates because they're not getting some good feedback, and you're going to see a high rate of inflation really play on the market. But of course, it's still going to play a factor on the price of the stocks, because here's the deal, man. There's a correlation between raising interest rates. It affects the overall stock prices, and they begin to plummet. With that being said, if they decide not to do it, interest rates will decide not to go up, or not decide to go up. Obviously, they're the ones that are in charge of it. If they decide not to raise the interest rates, obviously this is something that of course would be a good thing technically for the stocks in the short term, or the stock market, but in the long term, rate of inflation is still going to kill the majority of Americans. So that's just my kind of personal opinion. So really, kind of finalizing or putting the main 3 points of the video, looking at the 3 time frames. We say 2 to 3 years potential based on the fact of the matter if we do see a repeat of 07-08 based on historically looking at the bond yield curve. We can say sometime November, January, if potentially, you do see that gridlock, if the Democrats lose the House as well as the Senate. Historically speaking, like taking back a look at 2018 when the Democrats took over the House, it was good for the market economy. This happening in 2020 could also be good for the economy, because historically gridlock is good for the economy. And third, another factor is you could see the Fed start to push back on, the overall aggressiveness that they've kind of said in a further Fed meeting. If, of course, there happens to be more blowback, they've doubled down. I think that's a good thing for now. Of course, I could be wrong on this. If you have, your own personal opinion, please let me know. I would love to debate it with you. Or if there's anything you think I'm missing out on, let me know. But as far as it goes, I think that, the first real sign, once again, that we're going to see is the next Fed meeting. What's the sentiment? How's the market looking? But more than likely, we're going to see more bloodbath for at least another couple of months. And then from there, we'll take a look and see what happens in November, see what's going to happen. Are the polls right? Is the sentiment right? Is that going to help the market? And, at the end of the day, if, we see that bond yield correlation, then have fun being able to buy a Pokemon product at dirt cheap for the next 2 to 3 years. So those are the 3 time frames. Of course, you can pick your own personal interpretation on which you think which one of the 3 is more likely to happen. Of course, the second one being, the gridlock. Who knows? The Democrats could also keep the House and the Senate. Do I think that's personally good for the economy? No. Once again, going to gridlock has nothing to do with whether they're in power or not. I made the same argument in regards to when the conservatives lost the House as it being a good thing. So I want to stand that middle ground, knowing I'm not taking a political stance one way or another. It's just important to have that gridlock, because when no one does anything, then you can't screw it up. So that's just something that's very important for people to understand. That's just kind of how it works. So it gives a lot of retail traders and big institutional investors a lot of confidence in the market. But as far as it goes, that is really all I have for today's video. A little bit of an economic talk. Hopefully a lot of this really made sense. Once again, have any questions, have any concerns, please. Hopefully a lot of this made sense. Like I said, I obviously brought up a little bit of politics, but didn't give any opinion on it. I just gave you the straight facts, and hopefully that's what you guys felt from that, because I don't want to have any sort of political leaning or bias when I give you these videos. I want only to give you facts, statistics, because at the end of the day, I don't give a crap whether you're left leaning or right leaning. All I care about is that you guys make money, I make money, and that's what matters at the end of the day, because I don't give a crap at all. Other than that, that's what matters to me at the end of the day. But yeah, as far as it goes, as always, doing our weekly giveaways, all you have to do to enter is leave a like, comment down below on any of our 3 videos we post each and every week, Monday, Wednesday, Friday, as well as be subscribed to the YouTube channel. We continue to give more and more packs as we continue to grow our channel. Almost at 1,000 subs, we'll be giving away 8 packs to all 3 of our winners instead of 6, which is what we usually do. 3 winners, 3 opportunities to enter, so a lot of opportunity to win. But that is all I have for today's video. Thank you guys all so much for watching. Until then, I will see you guys on Friday. Peace.